Everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through together, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me at Fair Finance, and if you want to join our community, findinghighplay.com, I dive deeper into all these topics, subjects looking for investment opportunities and sharing them with community, answering your guys' questions during Q&A sessions during the weekend. We do have a special coupon code. Special is that code if you'd like to join for savings on the monthly and yearly membership. So Peter says, bear markets pale in comparison to bull markets, both in market movement and duration. A good reminder for every long-term investor. These are the bull markets, these are the bear markets. It is obviously much better to be biased towards being a bull because of the asymmetry here. You can lose 45%, but look at the upside. 204, minus 20, 304, minus 33, plus 841%. That's a big bull market there, baby. We had a big one from 09 to 2020 as well, 527%. So the asymmetry favors being a bull during this time frame. There are times where things look a little bit more balanced, like back here in the 60s and 50s. That was also an increasing interest rate environment back then, but also was here 487% up. So that's kind of the history of the S&P 500 bull and bear. And my opinion, bears sound smart, bulls make money. And I'm in the camp that I want to make money. And if I have to endure some pullbacks, even if they're pretty big ones like these, then I'll have to endure those pullbacks. I ride the wave higher. It's kind of what I'll say. Buy value and ride it higher. I thought this was funny. So Cactus goes, 7 years later, my confidence in Ethereum is dwindling. Someone says something positive, and Kevin says, you've nearly figured it out. I just thought that was funny. I was scrolling, I saw that, and I was like, oh, I got to share this one. Say something positive. You've nearly figured it out. that is just a confidence game. And yeah. So here's Sahara. This is a nice little chart of platinum, 10-year diamond. Will a monthly hammer candle at the end of it. So a hammer candle's got that big wick at the bottom, sells off, and people buy it back up and create these big wicks. There's another one that occurred in 2020, the overthrow of the diamond bottom. I actually bought a bunch on this wick there. I went gung-ho in 2020, early 2020, March and April and May. There was a bunch of good deals, but they did adjust the price higher in early to middle of March. They jacked the premiums up, and because the demand, see, this is what I don't get in the markets. Someone explained this to me in the um, comment section. So when I was buying physical metals in 2020, what happened was the paper price went to some ludicrously low levels for both silver and platinum. And when you go to buy it, this is what they did. They limited the amount that you could purchase at that time frame. Also, they jacked up the premiums at that time, so the price of the physical metal didn't go down very much. If you have a move lower like we did, why why did the physical buying spike? Doesn't that make no sense? I mean, it doesn't make sense to me. Wouldn't a low price mean that you have very few buyers because the price moves because you have no buyers? I find it weird that when I actually went there to my local coin shop. I went to trade some metals with gold trading for platinum and or silver. And I was evaluating the premium prices at that time. I find it highly weird of just the sheer volume of people that were there and how many were buying. I'm like, this does not seem like a bottom. It just seems weird. Bottoms are generally where nobody's looking. They don't want to buy. Everyone tells you you're stupid. Uh, People will tell you with, narrative, price drives narrative. So they'll tell you, there's no demand. There's none of this. It's a demand problem. Too much supply. That's kind of like what the bottom is. When I went there, they gave me a premium to do that trade, and they paid over spot for gold. And I got a whole bunch of other uh, great opportunities to pick this up with many ounces in relationship to the 1 ounce that I was trading in. So I don't know. It seemed weird. Come down to platinum, another one, ready and waiting. So he recalls in February, I was poised to and ready for a breakout of this incredibly compressed coil at the top downtrend channel. Yet no trigger as it failed to pop and instead went into a lower band overshoot. So here we are squeezing up. This is a long term, looks like a logarithmic chart coming down here. Been just peppering this upper area here. And eventually we will break out. He's got a potential um, move higher of about 2064. I think it looks good. We're underneath the cost curves. The platinum group metal mining companies have pulled back on production. I like platinum here. I like palladium even. I like everything. I like rhodium, platinum, palladium. I like it all. Everything looks cheap here. And with them pulling back on production, I think we'll get our time in the sun at some point. Donovan says, looking for international outperformance, keep countries on your watch list. He's got Italy, Spain, and Germany. What this basically is just the dollar ready to eat it. That's the way that I see it. There's a bunch of other emerging markets too. Mexico, Brazil, Argentina, Colombia. You can go through all of them. They also look pretty good. But they all share one thing in common. They all share that their currency is different than the United States dollar. And I have a feeling that the dollar, which they all are being compared against in these ratio charts, I think the dollar is going to go down. I think we're going to see a rotation of money out of dollar denominated assets towards other currency denominated assets. So I think that's just trend, and you're in all these different charts that everyone's looking. This is a double bottom, by the way. You get a lead in pattern, and then you get the double bottom. 1, 2, 1, and 2. Break. That also happens and occurs with commodity bull markets. Gold is our leader. And you know what gold is priced in? Right, the US dollar. So I think whatever's coming, I think we're going to see, and I can't tell you what it is. Don't know yet. A lot of money printed. Don't know for what excuse they make up. I don't know if it's they're already doing it, maybe, but that's what I think is coming. Here's another one from Sahara. This is copper. Recall, I have another bullish pattern which I've shown prior. Pattern is formed in the handle of the cup and handle just posted, giving more weight to the bulls, and it's a shoulder, head, shoulder, a projected target upper band there is $9.90 a pound. That's a pretty big move. Here's another one. This is the cup and handle. So we've got a cup and a handle. This is very similar to what gold did when it broke out. It's very similar to what silver is creating in a 45-year pattern. So there's all these cup and handles. They're starting to break out. You can see this one broke out there. One's trying to with an inverted shoulder, head, shoulder. So copper's looking fantastic. Now here's the thing, guys. I thought copper was a representation of the economy. Why is it breaking higher if everyone thinks a recession is coming? Well, I mean, copper could be in short supply. Maybe the dynamics have changed where before the economy needed to be strong and copper price would only go up if money was present in the system and was basically demanding more copper. But maybe this has changed into a supply side story. maybe supply is so jacked up, we don't have enough supply that copper is going to move up irrespective of what the economy does. Yeah, that could be another one. We'll see. We'll see how this works out in the end. Here's Canadian crude holding well above support. So Canadian crude's got that double bottom. The breakout is A, retest is B in here. Still doing the retest. We want to break this downtrend line. That's on Canadian crude. I like Canadian crude. I like the Canadian companies. They're a really good opportunity. I think they're some of the last exportable capacity that the world has. And we'll see if we break out to the upside. This is generally a bullish formation. This formation can also be seen in a variety of commodities. They double bottom, they break out, and some of them have failed and come back. These areas down here. Something like a rare earth metals has done that. Lithium has had pretty big pullbacks. EOPX has a double bottom like this, but it's located like up here. Uranium has a big double bottom, URA, that's up here. It's got like a big double move. So a lot of commodities are doing this same pattern here. I've got commodities here. This is the NASDAQ 100 divided by ecom spot index ratio. This is commodities. I think it's Bloomberg commodities. This is the top of 2000, and we've got a top and heading lower. This also is a similar pattern. You can see the sideways action there. Big blow off top. Sideways, pull down, blow off top, and I think we're going to roll over where commodities start to outperform the NASDAQ. At least that's how I'm positioned. I'm positioned for commodities to move on up. Hopefully that's exactly what we see over the next decade. And this was 2000 all the way into 2011, 2012 was that big bull market. We could go 2024 to 2034. Steven Straza says it's definitely not risk off when Mexico and Brazilian small caps are atop the international leaderboard. This is the 1 month versus SPX in Mexico, Brazil, Spain, Hungary. Everything's kind of outperforming last month versus the S&P 500. I do think this is going to deal with currency. Look for a weaker dollar. If we get a big weaker dollar, big move in it, I think these things are going to load to the upside. And I think Brazil is going to be a very explosive area. Mexico is also thought to be looking. Here's another one from Ronnie. He says, capital will always go where it's welcome and stay where it's well treated. Capital is not just money. It's also talent and ideas. They too will go where they're welcome and stay where they are well treated. Walter Wriston, American banker, and millionaires are fleeing Britain. Last year they saw the biggest outflow in at least a decade. UK high net worth individuals net migration. Capital's leaving where it's treated poorly or taxed a lot. Someone tell me the price spot needs to exceed to start buying uranium again. I'm on a plane there, and people responded with 2250 as per 67 uranium price. So 2250 is where spot needs to be. So let's see where spot is. We're at $20.56. We want to get above 2250. So 2250 is where they'll start buying back uranium, and it goes into. There's another one from Kevin. He says 33 million pounds of annual demand added 6 years by China alone. NextGen plans to ramp up likely sometime after 2030, will complete a 16-year process to being mined. Will peak around 28, 29 million pounds per year. 11 years life with average around 22 million pounds. NextGen was often spoke of as being the bear case for uranium just 5 or 6 years ago when chatted with financial analysts. They always struggle to see the demand coming, and it's still coming. It will blow them all away, and they will revise targets up and price forecasts. Next thing you know, there will be panic buying by the industry along with a return to squeeze plays speculating. History repeats itself. Here's more context. The 33 million pounds of demand added by China is 50% greater than Cameco's current 22 million pounds of production, its share from Cigar and MacArthur. There you can see MacArthur, production start, and kind of these guys rolling here. So that's the setup in uranium. We continue to add on massive amounts of demand for uranium. Here's breaking. The White House completely loses it over Amazon announcing that they will put a tariff price next to every item they sell, depicting how much of the price of that good is the result of Trump's tariffs. Caroline Levitt says, this is a hostile and political act by Amazon. Why did Amazon do this? It's not a surprise because Amazon has partnered with the Chinese propaganda arm. Americans have a right to know. It's not political, it's logical. Let's just see what that has done to the Amazon chart there. So they went down a little bit and then back up. So I do think that they rolled back that release and that they're not going to show the tariffs now, that the White House was losing its CRAP about it. So they might have rolled this decision back and not show it. But I thought that was interesting. The standard deduction for a married couple over 65 is $33,200 in 2025. They could convert from a traditional IRA Roth up to $33,200 and pay no taxes. Then use long-term capital gains tax at 0% up to $96,700 of taxable income to live off of. And that's what when I was talking about yesterday, this is the amount if married. Or no, this may not be married. Oh yeah, married couple. There it is. You can go up to $96,700 of taxable income if long-term capital gains taxed at 0% up to that amount. Do this for 5 years and you take Social Security at 70. You now have $170,000 in a Roth and paid $0 in federal taxes to live off in the last 5 years. So there is a lot of tax strategies that people can do when you're retired like this if you know what you are doing. So you might want to seek an accountant or someone who's a tax specialist to get these types of deals if you are thinking about retirement. And even if you're younger, you need to understand these rules so that you set up and deploy money in certain accounts to take advantage of exactly this. Also, it might be beneficial to take out more money in the beginning, use these long-term capital gains taxed at 0% up to $96,700. Even if your expenses aren't that high, you might want to think, you know what, I can take out the max and just deploy it somewhere else. So there's other things that you might want to think about that may impact you right when you retire at 55 that will benefit you for your entire retirement. So it's best to make a plan even well before retirement and how you fund the accounts that you have, and then look at potentially after you retire how you take that money out. And at least think about this stuff when you're younger so that you can appropriately apply money when you're young into those accounts, take advantage of this stuff, which will hopefully still be relatively the same after you retire in terms of the taxes. Ferg says, investors want certainty, yet asymmetry is greatly diminished by the time certainty has arrived. Let's break this one down. So investors want certainty. What rattles investors is uncertainty. So they sell stocks, they sell things off. Asymmetry is buying something that has far more upside than downside. So when you go and you try to buy bottoms in companies, that's when the maximum asymmetry exists. You have the lowest risk and the greatest amount of upside potential. So your risk reward is the best when the asymmetry is the largest. Only way you get the largest asymmetry is when there's uncertainty in the market or fear. So fear and uncertainty is maximum when there's the largest asymmetry and it's the lowest risk time to purchase. The problem is people don't like buying with uncertainty. So investors want certainty, but by the time you get certainty, your asymmetry is greatly diminished. So it is best to buy when uncertainty and fear is in the market because asymmetry and risk are the best. Here's another one, make gold great again. More gold shortages in China. Dealers slap on big deposit hikes. Deposits rising from 30,000 RMB to 50,000 for 1 kilogram bars with penalties if buyers back out. Gold shortages. Here's Jordan. He says, bad bear markets are different in secular inflationary periods. In the typical bad bear market, the middle part is the worst. In the last secular inflation from 68 to 70 and 73 to 74, those bears were somewhat mild until the very end. The final 4 months of each was the worst part. Not a prediction, but even in a bad bear market, the S&P 500 may not go far below the recent low until 2026. That's in inflationary periods where you get bear markets in inflationary. The Money Cruncher says an investor had $1 million split across 401k, Roth IRA, and a brokerage account. Thought he was diversified, but a simple mistake cost him $74,000 in extra taxes. Here's what went wrong. Most investors focus only on their ideal asset allocation. They only figure out what to invest in, stocks or bonds. But where you hold those investments, a brokerage account versus a 401k versus a Roth IRA, can impact your taxes. If you hold incorrect investments in incorrect accounts, you will pay additional taxes every single year. Fees and taxes also compound over time. There's an opportunity cost. So here's a better approach. Place bond investments in a 401k account, no income tax on interest. Place high growth assets in a Roth account, tax-free growth and withdrawals. And place tax efficient assets in a brokerage account. So that's how you want to break it down. You want to put the bond investments in 401ks, you want to put high growth in Roths, tax efficient brokerage account. So say in our case, this individual has 200,000 in a Roth, 400k in a 401k, and 400k in a brokerage account, with bonds and stocks evenly spread amongst all of these accounts. The problem with that is bonds generate taxable interest. It equals a tax impact based on the marginal tax rate. A Roth IRA doesn't grow as fast as it should, and huge tax and portfolio returns inefficiency. Vanguard's research shows that by following correct asset location principles, you can boost your returns from 0.05 to 0.3% per year just by optimizing the accounts. In our case, that is $74,000 less in taxes over the next 30 years, 22% marginal rate, 15% long-term capital gains, and dividends. So how do we adjust it? Want to sell the bonds in a Roth, no tax impact. Rebalance the 401k, no tax impact. Fix your contributions. For the brokerage account, selling could result in additional taxes. In a brokerage account, if you're using mutual funds, active management funds or target date funds, be careful. These have high turnover and rebalancing rates. Instead, choose passive index tracking ETFs. VI is generally a tax efficient fund. Most investors leave money on the table because they don't optimize asset location. It's one of the easiest tax strategies to implement. Do it once and it works every year. So be aware. And I know some people have asked me about taxes. There's a tax one. People keep telling me the economy is about to go into deep recession. that why Dr. Copper is flirting with new all-time highs, ready to break out? Yeah, I know. Is copper in a new era, or are we actually going to break out into some big boom? Is money printing coming? Maybe. Copper does not look bearish, it looks bullish. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel, subscribe to the website, use that special coupon code. Look for the Platinum Midweek Update. If you're a member, I go over the individual companies and kind of what I'm looking at, what I think looks good. And then I share my opinion freely through that update. So that's what I've got for today. We'll catch you next time. Finding value.